The global real estate market is currently valued in the hundreds of trillions of dollars, making it one of the largest asset classes in existence. This sector is the primary engine for worldwide GDP growth, infrastructure development, and long-term wealth creation. Traditionally, global capital concentrated in mature hubs like the United States and the United Kingdom, where established skylines like London's represented the gold standard for security. But the foundational parameters for evaluating these properties have shifted. Older investment models that rely on historical data alone are becoming functionally obsolete. New drivers, specifically rapid urbanization and deep technological integration, are moving the center of economic gravity toward emerging markets. India is a primary example of this shift. Large-scale construction is accelerating here, supported by massive urban migration and significant government infrastructure programs. To navigate this environment, investors are moving beyond broad commercial and residential categories to target highly specialized asset nodes. We are going to build a modernized, multivariable analytical framework for 2026 real estate, starting with the base asset layer. This multi-layered approach is the most reliable way to separate high-yield, future-proof assets from stagnant properties in the coming decade. Our model begins with the 4 traditional pillars of real estate: residential, commercial, industrial, and agricultural. The agricultural pillar provides the foundational scale of the market, including vast stretches of farmland and the essential infrastructure that supports food production. The commercial pillar includes traditional retail, like the multi-level layouts found in regional shopping malls and high-street entertainment complexes. However, the most significant movement in the market is occurring within specialized subsegments, where capital is increasingly concentrated. Warehousing is a prime example. This subsegment has grown significantly as a direct response to e-commerce expansion and the need for modernized logistics hubs. Data centers represent the next specialized node, which is expanding to meet the massive processing requirements of AI and cloud computing. These segments are all underpinned by 3 demographic drivers: urban migration, the rise of smaller nuclear families, and a growing middle class. In markets like India, these demographic shifts are now meeting large-scale government infrastructure initiatives. Modern transit projects like this metro system act as catalysts, allowing developers to establish new residential and commercial clusters along these high connectivity routes. On a macro scale, multi-lane highway interchanges are creating the transit corridors necessary for the next generation of industrial and logistics hubs. Manufacturing growth also relies on this infrastructure, as factory output requires efficient transit to reach global markets. This means property value is no longer just about a static location, but about proximity to specialized infrastructure and shifting demographic flows. Now we apply the second layer of the framework, the financial circuitry and macroeconomic levers that dictate asset valuation. Consider interest rates. Lowering these rates acts as a stimulant, increasing mortgage demand and home purchases across the market. Inflation also plays a role. Moderate inflation often serves as a wealth preservation hedge, as tangible property values tend to rise over long-term holding periods. We measure the performance of these assets using 2 primary metrics: return on investment and rental yield, which represents the annual rent as a percentage of the property's total value. While GDP growth provides the income that drives baseline demand, funding modern megaprojects requires more complex capital stacks. While banks remain the primary source for home loans, private equity and specialized housing finance companies are increasingly funding larger developments. For the individual investor, the Real Estate Investment Trust, or REIT, has become a critical vehicle for modern portfolio construction. REITs provide liquidity and professional management in a market that is otherwise difficult to exit quickly. Finally, foreign direct investment accelerates the development of large-scale commercial projects and industrial parks. Successfully managing these capital stacks and anticipating macroeconomic changes is as essential to generating yield as the asset's physical location. The final layer of the 2026 matrix involves the technological and regulatory filters that determine whether an asset remains viable. Artificial intelligence is now a functional tool for the industry, used to automate property valuation and perform predictive demand forecasting. Similarly, big data algorithms are used to conduct systemic risk assessments before major capital commitments. Blockchain technology is specifically useful for improving transaction transparency and accelerating property transfers in emerging markets. These technologies are governed by the regulatory environment, which serves as the ultimate filter for asset quality. Policy initiatives like India's RERA have already improved consumer protection by mandating transparency and strict project timelines. Simultaneously, stricter environmental codes are making green building practices a mandatory requirement for new developments. This includes features like water conservation systems and solar energy integration, which are increasingly becoming standard in institutional-grade properties. These sustainability features offer a measurable return, lowering operating costs while improving the long-term well-being of the occupants. Technological and environmental compliance are no longer optional additions. They are prerequisites for securing institutional investment. When these asset typologies, financial engines, and technological layers are fully integrated, they result in the complex developments often categorized as smart cities. These developments integrate housing, retail, and public services to generate higher overall property values than disconnected assets. Protecting these high-yield assets requires a dual-track risk assessment. Investors must still account for traditional market risks like oversupply and economic risks like rising interest rates. But now they must also map modern threats, including environmental risks from flooding and technological risks like digital disruption and cybersecurity. For policymakers, the path forward involves simplifying approvals and promoting affordable housing to maintain current demographic growth. Developers must prioritize IoT and green building practices immediately to avoid holding assets that the market will no longer value. Investors should focus on diversifying across specialized property types, using REITs for liquidity, and targeting established growth corridors. While short-term economic and regulatory challenges persist, the long-term outlook for global and emerging real estate remains positive. The highest potential for value creation in the 2026 market is increasingly concentrated in these tech-integrated, multidimensional models.